Welcome to The Explainer. Today, we're putting on our detective hats and going full forensic accountant, learning how to read a company's financial reports to find out the real story that's hiding behind the numbers.
You see a company, right? There's all this slick marketing, the CEO sounds super confident in interviews, but how do you really know what's going on under the hood? Is it a gold mine, or is it actually a landmine waiting to go off?
Well, the only way to get the real story, the actual truth, is to look at its financial reports. This is the official evidence, the direct window into what's really happening with the money.
Okay, so here's our game plan for this little investigation. We're going to talk about a company's true health, then break down the 3 core statements. After that, we'll learn how to read between the lines, and finally, I'll show you a really cool mathematical fraud detector.
All right, let's kick things off with the standard evidence available to any investigator, the 3 core financial statements. So you've got the income statement, the balance sheet, and the cash flow statement. Now, these 3 aren't meant to be read in isolation. Think of them like 3 different cameras filming the same event. Each one gives you a unique perspective, but when you put them all together, that's when you get the full picture. First up, you've got the income statement. This one is basically a summary of the company's performance over a specific period of time, say a quarter or a year. It's the story of what happened. It shows you the revenues, the expenses, and the bottom line. Did they make a profit or take a loss? Next, there's the balance sheet. Now, if the income statement is like a video showing the action over a year, the balance sheet is a single snapshot in time. It's a picture of the company's financial health on one specific day, listing out everything it owns, its assets, and everything it owes. And this is where we see that classic accounting equation, assets equals liabilities plus shareholders' equity. It sounds kind of technical, but the idea is super simple. Everything the company owns, all its assets, had to be paid for somehow. It either came from borrowing money from someone else, that's liability, or it came from the owners themselves putting money in, that's shareholders' equity. It has to balance out, always.
And last but not least, the cash flow statement. This one is so important because it just tracks the cash. See, a company can look profitable on paper, but still go bankrupt because it ran out of actual money. This statement shows you exactly where the cash came from and where it went, breaking it down by operations, investing, and financing.
Okay, so the big numbers on those statements give us a good start, but they're only part of the story. If you want to find the real clues, the hidden stuff, you have to learn to read between the lines. This is where we get to hear directly from the people in charge. We're talking about the management's discussion and analysis, or MD&A. The U.S. Securities and Exchange Commission, the SEC, literally requires companies to do this, and their goal is to provide a narrative that lets investors see the company through the eyes of management. So what does this MD&A actually tell you? Well, it's where management explains their financial results, talks about trends or big uncertainties they're facing, and even shares their outlook for the future. You get to see their perspective on things, the quality of their earnings, and the key metrics that they use to run the business. It's super valuable stuff. All right, now let's get to my favorite part, the footnotes. Seriously, this is where you find the fine print that can change everything. It's like the detailed notes an investigator scribbles in their notepad, and they are so important.
And I'm not exaggerating their importance. There's this story about an investor who found an undisclosed liability, basically a hidden potential debt, worth 185 million rials, just buried in a footnote. Spotting that one detail saved him from what would have been a massive 40% loss. That's a real-world example of why you read the fine print.
See, this is where all the secrets are. The footnotes tell you the specific accounting methods they're using, the detailed terms of their debt, if they have any lawsuits pending, and even potential future financial burdens that haven't hit the main books yet. We're talking about off-balance sheet stuff. It's crucial.
Okay, so you've reviewed the statements, you've read all the notes, but what if the numbers themselves are just made up? What if it's all a lie? Well, this is where we get into some really cool forensic stuff. There's a mathematical tool investigators use to spot deception.
So think about this. How could an auditor possibly spot a lie when they're looking at millions and millions of transactions? It seems like finding a needle in a haystack, right? But believe it or not, there's a surprising mathematical law that can help.
It's called Benford's law, and what it says is kind of mind-blowing. In tons of naturally occurring sets of numbers, we're talking everything from financial transactions to population numbers, the first digit is way more likely to be small. The number 1 shows up as the first digit about 30% of the time, while 9 shows up less than 5% of the time.
Just look at this expected frequency. A 1 as the leading digit is expected about 30.1% of the time. A 9? Only 4.6%. That's wild, right? It means numbers starting with 1 are more than 6 times more common than numbers starting with 9 in a natural data set.
So here's the genius of it. When people just make up numbers, they don't follow this natural pattern. They spread the digits out more evenly. So, if an auditor runs a company's data through a Benford's test and sees a huge, unnatural spike in numbers that start with, say, an 8 or a 9, that's a massive red flag. It suggests that someone might be fabricating or manipulating amounts.
So, auditors have a whole process for this. First, they prepare the dataset. Then they run the Benford's test. After that, they analyze any weird deviations. And finally, they investigate those anomalies. It's not a magic bullet that proves fraud, but it's an incredibly powerful tool that tells them exactly where to focus their investigation.
So, you see how it all comes together. Financial statements really do tell a story. But to get the whole truth, you have to be willing to read every single page, from the main reports all the way down to the footnotes.
And that's the bottom line here. The numbers you see in the report, they're really just the beginning of the story, not the end. The tools to dig deeper are out there for anyone to use. The only question is, what will you uncover next?